Just about 2 hours away now from that much anticipated monthly jobs report for August. Joining us now with their expectations, Tom Simons, U.S. economist at Jefferies, Dana Daria, co-chief investment officer, Envestnet PMC. It's great to see both of you. Thomas, you first. Sure. What do you think? What do you think we're going to deliver, given what we got from ADP earlier this week, which was soft?
Yeah, ADP was soft, but it hasn't been a particularly reliable indicator of what we're going to get the following Friday for quite some time. I mean, recall last month, I believe ADP overestimated the NFP number by something like 200K once we account for the revisions. So, I mean, I'm not particularly far off of the consensus. I think it's going to be a little bit softer at 165. I think private payrolls is actually something to keep an eye on because there has been a quirk recently where it seems like August is a particularly strong month for government hiring. So taking that out of the equation, going down to about 110K for private payrolls, I think that's where we see the constraints of supply on the labor market still, holding in to really put a cap on overall job growth.
Some of the strikes we've seen are going to maybe skew this a little bit, too. But,
yep.
Dana, what do we need? What do we, quote unquote, need? And you know where I'm getting at. It's like, what does the Fed need to see? What do investors need to see? We just made the turn into what is historically a tough month. So this may play a large role in how we begin it.
Yeah, I think it's a jump ball right now as to September rate hike. And obviously, we're in a period where, really what everyone's looking for is lower than 170, right? I mean, 170 seems to be the mark. So if we can get anything lower than that, you're going to see markets be thrilled about that because it says, OK, maybe we don't need that rate hike in September. And certainly, we've had some hawkish comments from July. The Jackson Hole comments really talked about parsing data, about the Fed paying very close attention. So Powell's being very clear that, it's not yet determined what's going to happen in September. He's going to look at the data very closely. And there's nothing that they're going to look at more closely than employment, right? The Fed mandate is inflation and employment. So, and you have to hand it to the Fed. We have thus far done a very nice job of sort of decreasing job openings without increasing layoffs, which is exactly what you want to see, exactly what leads to a nice landing here. So what everybody's going to be looking for in a couple hours, of course, is just let's keep that number lower. Let's see it decrease even more.
Yeah, JOLTS showed the lowest number of job openings in a couple of years. So basically, Thomas, what Dana's saying is bad news is back to good news. Now, we're looking for soft, but not too soft.
Yeah. I think that's fair. And I think it's more than just the job numbers, too, though, right? I think that the wage numbers are particularly important here as well. Last month, and actually for the past couple of months, it's been coming in about 0.4%. If you kind of look at last month, you could make the argument that there was a decline in the work week that may have inflated the numbers a little bit. But the Fed really wants to see that number decelerate a little bit more. If it can decelerate a little bit more without an increase in unemployment, without too many more job openings falling, that sort of thing, then they'll be extremely pleased with that. I really think that, given the constraints on the labor force and just like the sort of impossibility of really big job numbers, that wages is really kind of the next level of sort of, trying to get an indicator of whether or not they're going to go. My personal opinion is that I think that they're pretty likely to be done. They would have to see, I think, the number accelerate from here in order to really consider another rate hike. And, given the sort of just general soft tone of profit margins and business and that sort of thing, I would bet that that we're not likely to see that.
So, Dana, the saying goes, buy the rumor, sell the news. Do you sell the news? Do you sell the news of the final rate hike, excuse me? That's what Michael Hartnett over at Bank of America is saying in his most recent note.
Yeah, I think that's fair. Very recently, we were all thinking more likely than not, there is an increase in September. And, the latest data coming in, obviously, inflation has come down sort of in the same trajectory it went up, right? It went up very fast and abrupt, and it's been coming down that way. I agree. Wage growth is absolutely what the Fed is going to look at. Among many pieces of data. So I think now that we've sort of trended into this, maybe we don't get the rate hike. That is where you end up. I'll say, though, that line, I think, applies a lot to what we're seeing going on with earnings. And every time earnings kind of come out and the expectation of a nice earnings season, is already well baked in and maybe even a little bit over, so that you get great earnings. You get, companies like Nvidia coming in with a really good number, and the market not really reacting well, right? Not kind of seeing that stock price increase. So I think you're seeing that a lot in terms of what is going on in the corporate sector right now.
So, I mean, if you're the CIO, you have to invest on what the data has been and what you think it's going to be. And we're coming off, not the greatest month in the world, but more recently, of course, over the last couple of weeks, it hasn't been so bad. So now what's your view as we make the turn into September, Dana?
I think it's about, we're working on behalf of retail investors, right? We have hundreds of asset managers on our platform, many different styles and strategies. I think, boiling that down, the headline is going to be, are you looking at high concentration still in the client's portfolio, right? If they're invested in the market, if they're invested in most, actively managed products that are going to be some lower tracking error, kind of closet indexing to a certain extent is pretty common. You have to look at the concentration they're automatically getting just from the enormous eight and being at market cap weight. And, I recommend looking at ballast, right? Making sure the fixed income is where it needs to be. If there's tilt in that portfolio, considering defensive plays, and I mean traditional defensive plays, healthcare, for example, where you're pulling a little bit of the risk that's associated with that big tech and growth. And, not to say that you're predicting what's going to happen with rates, but you're sort of taking some of that risk off the table, because at the end of the day, we skew to the downside risk here. And for retail clients, that's what matters.